With an exciting and surprising first half of the year in dividend equity trading, what does the rest of the year look like? For example, big tech shares certainly rallied after announcing some new payouts. So what does it really all mean? And is there an opportunity right now for you? We're going to break it all down right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore, and I'm joined today by my guest, Ben Kirby, co-head of investments at Thornburg Investment Management. Ben, good to have you here in the studio. Good to see you.
Great to be here. Thanks for having me.
Good. So listen, it's a really exciting story, the theme of dividend-paying equities. There certainly has been a lot of conversation happening around that. We've seen some pretty strong markets over the last couple of quarters. Earnings this past season, we're still looking to be showing growth for the rest of the year. Obviously, the Fed comes into conversation, which we're going to talk about here. But certainly, we are looking at tech all the time. We've got these AI stocks, and it's very attractive out there. But we've got valuations, right now that look like they are pretty attractive at these levels as well. So what's the story? What are you looking at and talking about with your clients?
Yeah, so I think back up a little bit. We have a bit of an everything rally going right now, right?
Yeah.
We've had growth stocks working, value stocks working. Gold is up, commodities are up, international, emerging markets, so, U.S., so kind of across the board, it's been pretty easy to make money in the markets this year. We think that probably gets a little bit more complicated as we go into the back half because there are signs of some slowing because, rates are still pretty high because the consumer is, especially the low-end consumer, is struggling a little bit.
Right.
So going into what we think is probably going to be perhaps a less good second half than the first half, having more of a focus on dividend-paying stocks, quality companies, often have an ability to navigate that volatility a bit better than some of the higher volatility, more aggressive growth stocks.
Right. So if, in fact, we do have, let's back it up actually again. Thank you for starting us off that way. So the expectation now at the beginning of the year in January, we would have said 5 to 6 cuts from the Fed. Now we're looking at maybe 1 or 2. And who knows, really? We still have to look at a lot of economic data, which Powell's doing as well. If we do experience some choppy markets, if inflation maybe heats up again, or we see some other kind of exogenous shocks that come into the market, is this still the place where you would be investing your money as an investor? Quality dividend stocks.
Yeah, so I think the market is pricing in a soft landing at this point, which means if we don't get it, either if inflation is either higher than we expect, or the economy slows more than we expect, there are tails to this distribution. If we don't get that baseline case, that's where things can get a little bit more dicey for risk assets. So dividend-paying stocks, they have a lot of benefit to them. One is you're getting paid to wait. So even if we don't see a lot of growth, even if we're seeing volatility in markets, if you're positioned in those larger cap quality companies that are going to pay you 2, 3, 4, in our portfolios, we've seen 5% or even more dividends over time. That can just be a really nice ballast to your overall portfolio, and also supplements savers' investment income. So not just relying purely on bonds,
right,
but also relying on stocks to generate part of that income.
Right. We were talking about this earlier. I mean, bonds are attractive right now, especially when you've got a 10-year sitting at about 4.5%, and especially at the shorter end of the yield curve, like 6 months and 2 years. It's attractive, but then you can actually go out there and find yields with some of these quality stocks within the dividend portfolio that are actually yielding a little bit higher, which is really exciting as an investor. You can actually find some yields within equities.
Totally. So maybe first, treasuries I think look pretty attractive, right? Treasuries at roughly 5%, kind of depending where you are on the curve. However, credit spreads are actually very tight today. So investment grade spreads are low, high yield grade spreads are low. So that also pushes you a bit further out the curve to dividend-paying equities, which, as I said, especially if you go abroad, so the U.S. is a very low-yielding market. The S&P is yielding 1.5%. So compare 1.5% yield to treasuries at 5%, just a huge discount. If you go abroad and you invest in a certain type of company, you can find companies yielding 5%. And what's attractive about that, the income is the same as you're getting on a treasury, but there's growth potential too, so inflation protection. So coming out of a period where we've had high inflation, investors who were purely focused on fixed income investments lost a lot of principal in their investments, if you own dividend-paying stocks, your dividends grew over this time period. So it actually provided a real return, which was substantially better than the 5% that you were expecting.
Right, and the expectation here at CIO, we have a target on the 10-year at about a 3.85 by the end of the year. So we are expecting that rates are going to slowly decline, and certainly not to anywhere near historic lows, but lower than where they've been for the last almost 8 months or so. So let's go back to kind of earnings. They've certainly been solid for 2024, 2025. I think 11% and 13% respectively. So those are pretty solid numbers to put up. But looking forward, now we've got 6 months left for the rest of the year. Are you expecting, like, if the markets do decline, could the Fed step in again? Because you said in one of your earlier notes that you expect a Fed put, which means the Fed's going to jump in and try and help out. So what are your thoughts there?
Yeah, so I think one of the strongest points for the market today is that earnings growth is positive again, and earnings surprises have actually been better than historically. Financial analysts sort of adjust their models so that companies can beat their expectations. So this last quarter, 80% of companies beat sell-side expectations.
Right.
And, normally it's like 70%. So it was an even better beat ratio than in the past, and we're seeing growth. So earnings are kind of the strongest point in the market today. But yeah, as you look into the back half, I do think that the Fed put is back on the table. Whenever inflation was running at 5, 6, 7%, there was no way that we were going to be, even if the economy slowed a lot, that the Fed was going to be able to come in and save the day. Core PCE running now, 2.7%. I think that's back on the table. If we did see significant weakening in the labor market, if we saw credit conditions start to deteriorate, I think the Fed does have some of those cuts in their back pocket, and that should be supportive of the market at this point.
Right. Yeah. I mean, we're inching ever closer to the 2% target for the Fed, but not quite there. And Powell has certainly put his hands up and saying it's a possibility we don't ever hit that target, and maybe they have to kind of play in the sandbox a little differently when it comes to what they're expecting for their inflation target. But good stuff. So as we sort of wrap it up here, what's the real base case for quality dividends, dividend yields as we go into 2024, 2025?
Yeah, so dividend investing is a long-term strategy.
Yeah.
And for investors who want to take a multi-year or even decade-plus view, dividend investing has historically outperformed the market, and it's done so with less volatility. So that's the long-term saver's perspective, is to have a decent portion of your assets in income-generating equities. Now, at this moment in time, what's interesting is that strategy is at a discount, right? So if you look at the overall valuation of, let's just take the overall dividend-paying universe on a global basis and compare that to the growth stock universe. Normally, dividend-paying stocks are at a 25 to 30% discount. So they're always going to trade at a discount on a price-to-earnings ratio. Today, they're at a 50% discount. So they're trading at 13 times earnings, and growth stocks are trading at 26 times earnings.
That's incredible.
So that discount, 50%, if some of that closes, you're going to get your yield, you're going to get your growth, and you're going to get a possible re-rating relative to the growth stock index. We think that's actually a really good setup, again, for a strategy that has these long-term tailwinds to it.
Ben, thank you. It's a really compelling story. I'm glad you came by to share it with us. Good to see you.
Thanks for having me.
Great. Ben Kirby, again, co-head of investments at Thornburg. And thank you all for joining us. There's lots more information you can find at our website, ubs.com/views. Plus, you can follow us on all the social media platforms, particularly Instagram. Follow us at UBS Trending. Lots of great content there for you. And don't forget, if you have any questions or you want to continue this conversation, make sure you're talking with your financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everybody. And remember to keep your eyes on what's trending. See you soon.